up next, it's almost like we don't even need any real introduction because everybody saw and was clamoring. It's exciting. We have acting chairman Travis Hill here to talk about FDIC and the modern banking regulation, having open dialogue, open books, and open banking, all of which are very important to us here at AFC. And there's few people, I think, in the regulatory space, and I can say this for the long term, that have been more thoughtful and more interested in engaging in responsible innovation and facilitating that than the acting chairman. And so we're very happy to have been working with him for years, even when you were working with former chairman Yelena McWilliams. And so we're very happy to have him here on stage as really the first time that FDIC has been on this stage. So that's fantastic. And moderating the panel is none other than Juan Azel, who is a chair of Fintech, Banking, and Payments Group at Winston & Strawn. Winston & Strawn, like the acting chairman, has been around the space for a very long time. Juan and I go back to previous employers. He is a dear, dear friend, and we're very happy to have both Juan and Winston here as good partners. So I'll jump off the stage and get to the people you actually want to hear from. So thank you. Juan?
Well, thank you. Well, I am super excited, I don't know if you guys are, to have Acting Chairman Travis Hill here with us today. I think as Ian was saying, he has been a friend of this industry for many years. I was previously at Cross River, and we crossed paths a couple of times, I think when you were on as a member on the board. So really to start off, my first question is, let's take us back to the day after the inauguration. You issued a statement, which I think was a very telling statement because it listed a set of initiatives that we're going to talk about today regarding promoting and growing the economy and whatnot. But it was the day after the inauguration. How important was it for you to set the tone of the agency on day one?
Sure. Well, hi everyone. Thanks for having me. Yeah. So as Ian mentioned, so I had been at the FDIC for a number of years. So worked for former Chairman McWilliams. Had been on the board for a couple of years. So I had a lot of time to think about these issues and had a lot of preparation and spent a lot of time identifying things that I thought we could do better and differently. So there was a long list of things that I expected that we would start working on right away, and so thought it was useful to communicate that both internally and externally, and also felt like I thought it was useful to put out a statement that just had like a bulleted list of things without any fluff or conversation around it, because I wanted to convey that we were just going to hit the ground running and just hit a lot of different things and really be focused on the substance and the policy.
Those bullet points had, I think, one thing in common, that they all promoted a vibrant and growing economy. And that's a little different, I think, from what we've heard from the FDIC in the past. I think if you ask most people what the FDIC, if they even know who the FDIC is, they're going to say, oh, they insure my deposits, right? But now you have an agency talking about promoting the economy, the growth and a vibrant economy through initiatives like, again, we're going to talk about regulation and supervision and things like that. How important do you view the role of the agency in making our economy better?
Sure. I think policymaking is always a balancing act. So we have a number of important tasks that Congress has assigned us, first and foremost being promoting safety and soundness of banks, but inevitably that always has to be balanced with other competing objectives, economic growth being one of the key ones. And so I think from our perspective, we always need to be looking at whether we're striking that balance correctly. Banks play a critical role in driving the economy. They make a majority of small business loans, a majority of commercial mortgages, the vast majority of credit card loans. They play a vital role in facilitating payments and a whole host of other things. And I think we also want banks to be a driving force behind economic growth for a number of reasons, including the fact that if things are to blow up, we have tools we can use first and foremost being the FDIC's resolution regime. So I think that's a key piece that's informing everything we do, is wanting to promote a banking sector that's driving economic growth.
One of those, I think, key initiatives, I mean, I would say, being a regulatory lawyer, I guess, the reduction and modernization of burdensome regulations. And I don't know if anybody saw a recent article in the American Banker. I'm going to use my glasses. I was trying not to use my glasses, but it's just inevitable at this point. A former predecessor of yours, Sheila Blair, right? She wrote an article where she said community banks need, and we have a lot of those represented obviously in the audience, as well as the fintechs they partner with, right? That community banks need relief from a suffocating web of regulations. She called the regulations expensive, outdated, and often counterproductive. And she says that it puts community banks at a competitive disadvantage. And then she ends the article by simply saying that help for community banks must be a higher government priority. Do you agree with that sentiment? And if so, and I know you were planning some on that end, but if so, how do you plan to reduce that regulatory burden on community banks?
Yeah, so fully agree with the principle that a vibrant community banking sector is a major asset for the United States. Community banks offer more personalized products and services than other types of institutions. They know their communities, know their customers. And so I think wanting a well-tailored regulatory approach that enables community banks to thrive is a critical goal. I do think that there is a history of regulators speaking a lot about the importance of community banks, but at the same time continuing to layer more and more regulatory expectations on them that makes the model increasingly unviable. I think tailoring our regulations for community banks is an important government goal right now. Secretary Westin has talked repeatedly about orienting our focus towards Main Street, and that's a perspective and objective that we and many others across the government share. In terms of specific things that we're doing, we have a whole list of things. We are very soon going to propose changes to the community bank leverage ratio, which for institutions that opt into it, it relieves them of needing to calculate and report the risk-based capital charges. We've been making changes to we've proposed changes to some of our thresholds, looking to raise an index in particular for our auditing and internal control requirements. We're looking at a number of other thresholds to ensure that they are keeping pace with the passage of time. A lot of our changes to supervision are going to make material changes to compliance for small banks. BSA, Bank Secrecy Act obligations, so we are working with the Treasury Department and other agencies on changes to the BSA program rule. We at the FDIC have put in place a number of changes to our internal processes when it comes to our BSA exams. So I think those are a few examples, but the notion of wanting a compliance regime for community banks that is thinking about the long-term prospects of the community banking model is something that's going to continue to be front and center in our mind.
Yeah, I'm going to touch upon supervision in a second, because obviously it goes hand in hand with regulations. And you mentioned that you want, or I thought this was a theme, and you disagree or agree with me, but that you were looking for a transparent and open-minded approach in bank supervision, being a recovering CCO, and probably a lawyer as well. I remember that in previous FDIC administrations, sometimes it felt like it was the examinations were hyper-focused on enforcement, right? Almost like a gotcha type of approach, right? And when you're dealing with such complex products and services, because sometimes it's the same products and services, but as we deliver them through technology, sometimes it complicates a bit the regulatory obligations, right? And how you comply with them. It's just the nature of the game. So a lot of, I think, of our CCOs, of our legal departments, want their regulators or examiners to collaborate with them to do things right? To help them reach those best standards or best practices, or sometimes they're not there. And I don't think they've seen it, this is me speaking, necessarily in the past few years. So how important to you is having that transparency and that open dialogue with the banks, both on the field examiner level and obviously in DC and whatnot?
Yeah, I mean, I think it's extremely important, particularly when it comes to the approach to banks that engaged in partnerships with fintechs and adopted that model. I've been very critical in the past of the supervisory approach, which was effectively regulation by enforcement. I think what we saw over the past few years was an example where examiners or regulators were kind of going down the line of issuing consent order after consent order, and it put banks in the position of trying to glean from each consent order what the supervisory expectations were. And so I think both from a policy perspective in DC and from a examination perspective on the ground, I think trying to be as clear as possible in terms of what our standards are, what our expectations are, and then supervising based on the expectations that we've communicated. I mean, I think that's the goal and the objective of how we should do.
It sounds pretty reasonable, right? Obviously, and I think sometimes the goals may have not been communicated appropriately, and then you're being supervised on things that you're not sure how to solve. I mean, and I speak just from experience. I'm sure many of you have had that experience here in the past. One of the things that I loved about your statement is that you followed it up with specifics, and I don't think we've heard enough specifics from any of the federal agencies in the past. So I'd love to hear that. Was reading you had a September meeting, right, of the Financial Stability Council, where you drilled down on supervision with 9 specific, I guess you could call them sub-initiatives. One of them stood out to me, and you said that you wanted to impose guardrails on and improve the consistency of the supervisory process. And consistency has been something I think that a lot of banks have had an issue with in the past. They feel like because they're in a particular region, they're being supervised a little bit more strictly than in another region of the FDIC. And sometimes I think, this is speculation, but having been in the industry, sometimes you feel like your clients, your fintechs may be form shopping, right? Choosing particular banks because they're in a region of, whether it's the FDIC or the FRB, it really doesn't matter, because they're less likely to have, or a lighter touch, right, on regulation, which obviously cascades to them through third-party risk management. So is that what you mean by consistency, or what do you mean by when you talk about the consistency of the supervisory process?
Yeah, I mean, I think consistency, it applies both to examination teams within the agency, and then also trying to achieve consistency among the different agencies as well. From our perspective, it's a hard problem to solve. But it's one we are thinking a lot about, and a lot of the initiatives that we're putting in place, we're doing them either to achieve better consistency or trying to think through how do we make sure the changes we're making are being applied in a consistent way. And part of that is going to be training. Part of it's going to be changes to manuals, internal procedures, things like that. Things like our new supervisory appeals process are intended to try to promote more consistency. But I think at a fundamental level, part of the challenge is when you have a disparate examination workforce, there's a trade-off between the best way to achieve consistency is to centralize decision-making, but the more you centralize decision-making, you're going to suffer costs in terms of both timeliness of decisions and also the ability to take into account the nuances on the ground. And so I think trying to figure out what the right balance of that between, on the one hand, again, wanting to ensure consistency, but at the same time, wanting to have an efficient process where we can react to things in a timely way. I think there's just a lot of work that needs to go into trying to strike that balance the right way.
Yeah, I know there's been some efforts to try to reduce, for example, when a report of examination is issued after the end of examination, sometimes it's been a little bit longer than I think anticipated. But I'd love to hear what you said about consistency. I wasn't even thinking about it in that term within the different agencies, right? Because as far as I think anybody who's been doing this for a long time, particularly in their legal field, you always have a client that asks you, I want to file the Novo Charter, which we'll get to in a moment. Which agency is best, right? And it kind of changes over time. Sometimes you're like, yeah, the OCC is going to be more, amenable to your application. Sometimes it's FRB, sometimes it's the FDIC, right? It just depends. It would be great to have one consistent examination, guide, threshold, right? Where no matter what bank what agency you feel that that there's consistent. And I think that's for some part third-party risk management because of that interagency guidance has kind of probably as close as I've ever seen it. With respect to the individual agencies. How about the frequency of regulation? Sometimes I think the banks feel that they're always under examination. There's exams, there's targeted reviews, there's then you have obviously your safety and soundness and then your compliance exam. And it almost seems like they're daisy chained, where a bank, or a compliance officer in particular feels like they barely have time to actually run the bank because they're responding to, regulatory requests, right, for information and whatnot. Is that something that you're looking to address? I noticed you said something about reducing the frequency, but please expand.
So I think when it comes to exam frequency, there's a pretty broad spectrum. For the smallest institutions, those banks on the safety and soundness side are on generally an 18-month exam cycle, and then the compliance side, the frequency is a lot further dispersed. And then for the largest institutions, they have examiners there pretty much the entire year. From our perspective, so I'd say the most significant thing we changed was we expanded the compliance cycle for most institutions with less than $3 billion in assets. And so, for a good chunk of those institutions, it's basically going to be approximately once every 5 or 6 year compliance exam with a truncated mid-cycle review. And then on the safety and soundness side, we've made some changes to our continuous exam program, specifically for banks that are in the $10 billion to $30 billion range. But I think at sort of a deeper level, part of the question is sort of what is the criteria for additional supervisory attention. And so there's the supervisory cycle that's part of that, and then there's also, to your point, sort of to what extent are we doing sort of targeted reviews. And I think some of the changes that we're doing in supervision reform more broadly will have an impact in how much attention we're giving in some of those areas.
And when a bank gets in trouble, which is inevitable, right? You talked about modifying the FDIC's enforcement policy to allow for the termination of enforcement, I'm just reading it, orders when a bank has achieved substantial compliance. I think this would be a welcome addition to a lot of banks who, when they do get in trouble, they spend a lot of time and effort and money, most do anyway, in remediation, but they never feel, they never see the light at the end of the tunnel, right? They never feel when they're going to get out of this. What's your thinking about how do you think you will be determining when a bank has achieved substantial compliance, in a formal enforcement action?
Yeah, so this was driven a little bit by when I was vice chair. I saw certain examples of institutions where there'd be an enforcement action issued to the institution. There'd be some significant material change at the institution where the underlying facts to the enforcement action just were no longer applicable. But nonetheless, the exam team would not let the institution out from under the enforcement action until they had complied with the specific letter of every provision, even when some of those provisions, again, just were no longer applicable based on changes in the business at the bank. And so the idea behind the new policy is it's generally to allow examiners to pull back the enforcement action when the spirit of the underlying enforcement action is complied with, even if there may be certain minor things that are still outstanding, or if there's a sort of material business change or something like that, that could also be a justification for making the change. The other piece of it is those decisions now can be made within the regions, whereas following a change back in 2022, in order for any institution to get out from a consent order without complying with every single letter of every provision, it had to get signed up by multiple people at very senior levels in DC. There had to be consultation to the chairman, and so it was a very cumbersome process. Whereas now, again, these things can be kind of decided out in the field.
Yeah, related to that is the SARC process, right? every agency has this, the Regal Act required supervisory process, but having represented several clients in these processes, it never felt like a level playing field. It felt almost like a foregone conclusion. And when you went and you did some research as to actually how many banks were successful, the amounts are so low they're probably almost hard to quantify. I think the SARC seems to be something that you focused on, because you have proposed a independent office of supervisory appeals to replace the SARC. I understand that you were looking to promote impartiality and consistency. Can you talk a little bit about how you think that office, the OSA, will achieve that goal?
Yeah, so I've been involved in the appeals process for a number of years, and I do think the SARC, just the general setup of it, has a number of flaws. I will say that I did chair the SARC in 2023 and 2024, and we did find in favor of banks on several occasions. And so, can't speak for other time periods with the SARC, but at least there are some examples of, it wasn't a complete, a complete impossibility for institutions to win at the SARC. That being said, I do think that the composition of the SARC was, again, has flaws to it. So the general idea of it is it's a board level committee, so there's essentially a board member who chairs the committee most of the time, and then deputies of other board members serve as the other voting members, or in some cases other staff within the agency. And I think some of the problems that the new office is designed to address, one issue is just the fact that model just can't really scale. The idea of the new office is, depending on what the volume of cases coming in, you can kind of hire more or less, and again, and can kind of scale depending on the robustness of the pipeline. Another issue is, just in terms of the idea of the new office is we would hire people that have specific experience relevant to the supervisory process, so former examiners, potentially former people from industry, but people who have direct experience with the supervisory process, non-political, impartial. Yep. Whereas the current SARC, again, nothing against political appointees, but essentially you have a political appointee and career staff at the agency. And so the idea here is we would be hiring externally just for this role. FDIC employees would not be eligible for it. The office would be standalone, completely independent from the examination divisions. And again, it's all to kind of try and drive a more independent process than in some cases the SARC might have. And one other piece of it is just some of these, again, different cases have different issues that are raised, but some of them, there really is a lot to go through, and especially when there are, some of these cases will be, they'll appeal like 7 different things. It'll be multiple different CAMELS ratings. It'll be an MOU that was issued, and the backstory sometimes will go back 6, 7, 8 years, and there's, to really understand it, you kind of have to go through the entire history of it. There's a lot of exam reports, a lot of correspondence. The bank may have models that it had developed where there's supervisory disagreements over, and again, this can be hundreds of pages and lots of complicated things to go through. And so I think there's a lot of benefit of having people where this is their primary job and focus, as opposed to sort of an ancillary duty for other officials.
Yeah. Let's take, because I want to try to get to a couple of questions that I think are very important. De novo charters, right? I think in April you noted, you weren't shy about saying it. Basically, you said that the applications had fallen off a cliff, right? Which I don't think is very good, right? For any, I think we can agree on that. But that you were reevaluating how it processes or how the FDIC processes applications from organizers proposing banks with new or innovative business models. Could you tell us a little bit about how you're encouraging de novo bank activity, as well as perhaps improving the Bank Merger Act, right? Process, which is related, obviously, if you want to buy an existing charter.
Yeah, so those are both things we are continuing to work on, trying to find ways to encourage more de novo activity. That's essential for the long-term viability of the community bank model, being able to have a pipeline of new entrants into the industry. So we are looking at things both on the process side of it. We're looking at some of the approval processes that the chartering authorities have. Are there ways we can shift our process to be a little more aligned? And then from an analytical perspective, looking at things like expectations around management, expectations around capital, things like that. Those are things we're continuing to look through. And then on the bank merger side, likewise, we rescinded the 2024 statement of policy earlier this year. We have put in place some internal changes to accelerate timelines and improve the process. And we are continuing to think through potential changes to our analytical framework from we've gone back to the legacy approach, but we're now thinking through potential forward-looking changes.
And I understand that you've seen an increase not only in bank charters, but or IDI charters, but I want to talk a little bit about industrial loan companies, right? I know that you issued an RFI earlier this year. You got your comments, and you're looking through those comments. There's been a lot of, I think, consternation, and it seems to be in Congress. And Senator Warren recently called for a moratorium on ILC charters until the Bank Holding Company or the FDIC can be amended to make it the charter subject to the Bank Holding Company Act, which would kind of eliminate one of the, I think, advantages of the charter. What do you think about that and ILCs in general?
So the legal framework for ILCs was set up by Congress. So we are, that being said, as you noted, we did issue an RFI. I know there's a lot of strong views on ILCs. The general idea of the RFI was, let's ask a bunch of questions about how to apply the statutory factors to different types of applicants. We've received a lot of comments. We've been going through those, a lot of helpful, constructive comments. And so now we're in the process of digesting those and thinking about what that means for our approach going forward. In terms of issuing a moratorium, that's not something we have planned. We do have some applications that have been pending for quite a while, and so we are looking to process some of those applications, but at the same time we are trying to be thoughtful about what our long-term approach is to ILCs, and would like to be as transparent as we can in terms of what our long-term approach is going to be.
Yeah, no, that would help obviously for a lot of the individual. Because the question we always get is, how likelihood am I going to get approval, right? I don't want to spend $500,000 or whatever in finding this. So that I think is one of the things that has likely made less applications a reality over the past few years. We have about 10 seconds, but I need to ask you about debanking, because I think you have very strong views about debanking, maybe as well as the president has on that. You've called basically for the elimination of debanking. You stated that the FDIC is working on rulemaking to prohibit examiners from criticizing institutions. You roll back reputational risk, as well as the other agencies, from the multiple examination manuals, and you're requiring you're prohibiting examiners from requiring, direct, or even encouraging institutions to close customer accounts on the basis of political, social, cultural, or religious views. Can you share a little bit, in the last question about debanking and how important you think this is?
And I've got 10 seconds.
Yes. Okay. No, I think you have a little bit more than that.
Yeah,
I'm sure Phil will give us.
Yeah. No, I fully agree with the principle that I think we want a banking system that works for all law-abiding American customers and businesses. So you mentioned the reputational risk rulemaking. We did propose that jointly with the OCC, which, as you noted, would prohibit examiners from criticizing on the basis of reputational risk or encouraging closing accounts, depriving of accounts for some of the reasons that you listed. We also are complying with the president's executive order, so we have reviews that are underway right now. We did send out request lists to some of our larger institutions. We've gotten responses to those that we're going through. We're looking through our complaint database, analyzing the results there. We've done a couple of other things as well, but all of that continues to be underway, and we're continuing to work through all of that.
Well, thank you so much, and I have to say good luck on your confirmation, and we thank you for coming out here and speaking to us. We could speak for 2 hours, I think, more on all these topics, but we appreciate the time.
Sure. Thanks, everyone.
Acting Chairman.